Hello, everybody. This is Patrick Randall, owner of Bulldog Financial Planning. This video is going to be about the One Big Beautiful Bill. I'm breaking up the One Big Beautiful Bill into a few different videos. During this video, I'll be covering four topics that are part of the One Big Beautiful Bill. And thanks for watching. I appreciate you tuning in. Please reach out if you have any questions about anything that I cover during the video. And as always, when it comes to uh, your tax return, please reach out to your accountant or tax preparer, CPA. I usually recommend people work closely with their tax preparer in terms of determining the exact dollar amount of what to expect on your tax return. Okay, so thank you again. Here we go. All right, so with the One Big Beautiful Bill, this was signed into law on July 4th, 2025. And the new law serves as an extension or a replacement of the Tax Cuts and Jobs Act of 2017, the TCJA. This was set largely to expire at the end of 2025. The TCJA had a lot of provisions, such as I'll cover a few of them here, but the tax rates were different. Standard deduction was higher, and as a result, the with a lot of those set to expire, the One Big Beautiful Bill had several of those aspects made permanent. Um, Many of the provisions were part of delivering on Trump's campaign promises, however, with certain specifications and limitations. The bill was debated a lot in the Senate and in the House of Representatives. We expect there to be further guidance from the IRS on a lot of these provisions. The information presented in this presentation comes from a lot of different sources, including the IRS website. So, first, the TCJA tax brackets have been made permanently extended. These were set to expire in 2026, which made tax planning more difficult and challenging for people because a lot of us were expecting potentially higher tax brackets as a whole for every filing category. The tax brackets, as part of the One Big Beautiful Bill, uh, were essentially made permanent as part of that, and we can see that's 10%, 12%, 22%, 24, 32, 35, and 37. The higher standard deductions remain. So part of the TCJA was that the standard deduction was made higher. Before that, the standard deduction was lower. People typically, whenever they're doing their taxes, you're going to be choosing either the standard deduction or itemizing your deductions. The itemized deductions, there are a number of those. I'll be covering those in more detail in a future video. But the idea is if you had enough itemized deductions, you would choose those rather than the standard deduction. Really, it's whichever's of the two was higher. Uh, that is still the same. You're going to choose either the standard deduction or your itemized deduction, whichever is greater. However, the TCJA introduced higher standard deductions, which means more people would be claiming the standard deduction, which generally means more tax savings for everybody. Less people would have to itemize to get, a comparable size deduction. This also means that the standard deduction is expected to continue to increase each year. And for 2025, married filing jointly, you can see is 31,500. So if you are married and filing jointly, if your itemized deductions were in excess of 31,500, then you would want to itemize. One of the campaign promises that Trump had was no taxes on tips. Now, this next provision addresses that. However, we do see that there are some limitations. So, this is a temporary deduction for federal taxes. Tips are still going to be considered part of your total income. So, people who are eligible, who report tips, they'll still need to pay payroll taxes on those tips, which includes Social Security and Medicare taxes. In addition, you could end up still paying state income taxes on those tips. However, what this provision does is it allows those individuals to deduct up to $25,000 of those tips that they had to report, regardless of their filing status and whether they itemize or use the standard deduction. So, this deduction is in addition to your standard deduction or itemized deductions. This does equate to some significant tax savings for those people who have, a large portion of their annual pay coming in the form of tips. This is eligible for tax years 25 through 2028, which means after 2028, in 2029, this would be set to expire. Similar to the TCJA tax bill, we could expect more debate on this in 2028 before these expire. So we don't know exactly if this will at some point be modified. It could drop off completely, or who knows, maybe it would become permanent, but that is to be determined at a future date, most likely sometime in 2028. There are phase outs for this. So, phase outs, people who are single or head of household who have modified adjusted gross income of greater than or equal to $150,000. They would see a reduced deduction eligibility, essentially. So they couldn't deduct as much as they would if they were eligible for the full deduction. This is also up to the amount of money you have in tips. It's up to $25,000. Similarly speaking, married filing jointly, modified adjusted gross income would be $300,000 or more, at which point the phase out would start to begin. For self-employed individuals, the deduction couldn't exceed net income. Lastly, for today, we have no taxes on overtime. Another campaign promise, and this it was developed in the form of another temporary deduction for federal taxes. Also effective for tax years 2025 through 2028, and individuals who receive qualified overtime compensation may deduct the pay that exceeds their regular rate of pay, such as the half portion of time and a half compensation that is required by the Fair Labor Standards Act, FLSA, and that is reported on Form W-2, Form 1099, or other specified statement furnished to the individual. That's straight from the IRS website. Overtime pay, just like the tips, are still going to have to be included in your total income as a top line add-in. However, you do have the opportunity to deduct up to $25,000 of your overtime to help reduce your taxable income. That does ultimately reduce the taxes you owe at the federal level. You may still owe state taxes on this. And however, the amount that you deduct is going to be eligible for you to deduct regardless of whether you itemize or you use the standard deduction. So it's going to be in addition to your itemized deductions or the standard deduction, whichever one you end up using. The other stipulation with this is you can deduct up to $25,000 for those married filing jointly, while all other filers can deduct up to $12,500. So there is a bit of another caveat there, where if you're not married filing jointly, the max deduction you could take is $12,500. The deduction would expire as is right now in 2029. So that will depend on what happens in the future. Phase outs, we have single head of household, modified adjusted gross income of $150,000 or more, married filing jointly, modified adjusted gross income of greater than or equal to $300,000. Thanks again for tuning in for these quick updates on a few key components of the big, beautiful bill. The sources cited are found here. Feel free to reference those. Please reach out to Bulldog Financial Planning, LLC, if you're interested in doing tax planning as part of your overall financial plans. And I hope you have a great day. Also, please subscribe and keep your eyes open for future videos on more topics from the OBBB.